Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for January 29th, 2023. I hope you guys and gals are having a great weekend, and I hope you're ready for an amazingly busy next week. We have many central banks that are actually making decisions on interest rates, like the Fed, the ECB, the Bank of England. We also have non-farm payrolls, and there's a ton of earnings next week. So we're going to talk about all of that and more in a few minutes, and actually in just 1 second. But I wanted to say before I get started, this is the last week of our pricing discount. You can see the New Year offer. It is literally going to be cut off at the end of this weekend, starting Monday. So if you wanted to take advantage of the pricing discounts, 40% discount on annual subscriptions, buy 1 month, get 1 month free. You know, this is the pricing discounts that we only do a couple times a year. So when we do it, and you can take advantage of it. And when it's gone, it's gone. Most of you know that. Most of you wait around the entire year waiting for these pricing discounts. This is it. On Monday, it changes back. So anyway, I just wanted to say that, you know, with Forex Analytics, just so you all know, you get this amazing platform you can see right here. I just actually closed out the data flash, which, you know, gives you, news as it's released, you know, kind of like Bloomberg. It's really a nice little system to have. Also, you get, you know, live squawk feed. You've got all of your analysis at your fingertips, 30 different instruments, not just currencies. Obviously, we cover cryptos, indices. We don't cover individual stocks, but you can see we cover a lot of cross rates. And then on top of that, you get, you know, several different types of analysis, whether you're talking about Elliott wave, harmonic analysis, basic technical analysis, macro analysis. And then on top of that, you get this amazing trades room where you can see the trades that I'm taking, some of the losses that I'm taking, other traders that are in the markets, not just our staff. You got the general chat room where there's just a lot of conversations that's happening about, you know, climate change here, talking about the S&P. Speaking of the S&P, we have an indices chat room where, you know, people are talking about where they feel the markets are going. And then we have the Flowonomics room, which is more of a macro chat room. So there's so much going on inside of our community. Make sure you take advantage of it by being a Forex Analytics subscriber. Okay, now that I'm past that, we're going to jump into the live charts because I actually want to talk about a lot of the central banks that are you know, making decisions this week. And, you know, the number one is going to be the Fed. Number one because, the Fed will probably be the central bank, one of the major central banks right now to really pause, you know, following the Bank of Canada this week. But we're going to be raising rates more than likely in a 0.25% or 25 basis points. And then from there, most people feel that the Fed is actually going to stop raising rates. But if you look at other central banks, like the European Central Bank, they are set to raise rates 50, and maybe even further, you know, going into May and June, higher rates. And Bank of England, yeah, it's kind of questionable, but the fact is the Fed will be meeting first, and that is going to be, you know, very important. Now, I want to stop for a moment and just say that even though the ECB is expected to raise rates a couple more meetings, probably another % at least, they're going to continue to raise rates more than likely. Most traders, institutions, we're all aware of that, so it's been priced in. That's one of the reasons why the dollar index has been under such pressure for the second half of 2022 and into the beginning of this year. Now from here, it's all about expectations. One of the things that you guys and gals have probably noticed is stocks have continued to rally and strongly rally into this resistance zone that we talked about last week. We're right at 4,100. I think let's take a look at the high. The high last week was 40.94, and that happened on Friday. And this is the little blue box that we drew last week. Do you remember drawing that last week? Yeah, we're into that resistance zone. Now, knowing that we're right into that resistance zone is a very key component to this week because the market is actually trading very aggressively, bullishly into this FOMC meeting. And what the reason why that is, for those of you that haven't been following along on our daily shows, and let me go ahead and show you, just, you know, when you're talking about our daily shows here, if you haven't been to them, make sure you go to the Flow Show Also, you got the F.A.C.E show; those are free. Now we have other shows that are for Forex Analytics subscribers. Once you're in the community, you can go to all those private shows. But these two are public, and not just myself, but the rest of the team update you on how they feel about the markets throughout the course of the week. Those are free. Make sure you get logged in, and those are you can get those links in the description of this video. But the reasons why the stock market has been so strong going into this Fed meeting is because most people believe, most traders believe, and most market participants believe that the Fed is going to not only pause in raising rates, but they're also going to be cutting rates in the future. This is where the big disconnect between what the Fed governors, regional Fed governors, the Fed chairman has been saying versus what the market is expecting. Most of us, and I'm gonna just speak to most of us in the markets, meaning that that whether you're in the you've been in the markets for less than 20 years or maybe over 20 years, like myself, like 25, 27 years, we've only really known a reactive Fed that really cuts rates when we're in a recessionary period, when growth starts to slow. And a lot of people believe that because inflation is still very sticky, because jobs continue to be very strong, that the Fed can keep rates higher for longer without cutting rates. And this is where the real disconnect, because the market doesn't believe it. The market, most participants now are of my generation and earlier or later. That means they've been in the markets for 25 years or less, let's just say. And so most people say, yeah, we know what this Federal Reserve is going to do. They're going to be cutting rates, as they see a little sliver of weakness in anything, whether it is, the jobs report or the jobs market, the labor market, or it's in the economy as a whole. The Fed's going to start easing and loosen financial conditions. But there's a lot of old school folks that have been around the block a few times. They will tell you that they do not believe the Fed is going to do this, and they're listening exactly what the Fed is saying. And that, again, the market is trading bullishly, expecting the Fed to be a little bit more dovish. But also keep in mind, inflation is well above where their mandate is at 2%. So and jobs continue to stay strong, which is going against their inflation forecasts or people's inflation forecasts of continuing to come down. So this is going to be really important this week, listening to exactly what the Fed is saying and what they do. They might adjust QT. They might actually raise rates more than 25%, which or 25 basis points, which again, I don't think that's going to be the case. Or I'll just say I don't think that's going to be the case, but there are people that are speculating that. And those are things that we have to be watching as the Fed does meet. Now, that's going to set the pace for the remainder of the week. If we walk away from Wednesday believing that the Fed is going to keep rates high, and they might keep them high for a longer period of time, or maybe they adjust QT maybe a little bit more aggressively, we could actually see a reversal here. But the market is well prepared at this point in time that, we've been rallying pretty substantially going into this Fed meeting, that if we get the same thing that we've gotten for the last couple of weeks, what I think might happen here is you might actually see a rally above resistance into the Fed, following the Fed, and then a reversal of, you get a buy the rumor, sell the news type of event for this market because it has been pressing so aggressively higher. And so I would be looking at resistance in the S&P coming in right around the 4190, 4200 level. And if you think about that from like a harmonics perspective, or maybe like a Gartley pattern, right? That's what it would look like. Something like this, where then you'd see a reversal up around the 4200 level. Look, I'm not short the S&P at this point, but if we get anywhere close to 4200, I'm probably going to step in front of the train and try to short counter trend, because I do believe we are going into a recessionary period, not only in the US, but globally. And I think it will eventually weigh on earnings. It's going to weigh on the markets. And speaking of earnings, we have a lot of companies that are actually reporting this week. I know a lot of people are just looking at Alphabet and Meta and Apple. Yeah, those are important, but there's other companies that are also reporting. You got UPS, which is really big when you start thinking about global deliveries and how much things are moving around the earth. You got big energy companies like ExxonMobil, you got Pfizer, you got McDonald's, Caterpillar. Let's see, any other big ones that could come to mind. Like I said, we do have Meta, we have Boston Scientific, we've got Eli Lilly, Merck, Bristol Myers, Qualcomm. There's Starbucks. There's a lot of big, where we can gauge kind of the consumer. There's a lot of big companies, and also General Motors and Ford is also reporting. But we could go. The list goes on and on and on. All I have to say is earnings season this next week is going to be very, very key. All in all, earnings have been all right, but it's the forward guidance that we're going to be looking for going into this next week or into this next quarter that's going to be really important for a lot of these companies. Now, I want to stop here and I'm going to talk about currencies, because let's go over to the dollar index. The dollar index has been in this bearish channel. The dollar did not move much this last week. It was more of a consolidation. And if you look at downside targets of the dollar right now, downside targets of the dollar probably come in closer to, I would say, this, 101, maybe even a little bit lower than that, right around here. I think that would be, a near-term target for the dollar. And then also, we'd really have to get above the 103 to really convince myself or anybody else that the dollar is ready to turn higher, meaning that we're set up for a counter trend move. Above 103 is going to be very critical for the bulls to take. There are a lot of traders that are looking for a reversal, but think about what the dollar has been doing and the reasons why it's been going down. It's really the divergence between central banks. You got the European Central Bank that is very, very hawkish. You even have the Bank of England that's going to continue to raise rates, probably a little bit more moving forward. And then you got the Fed that's going to be pausing. So that divergence is really what's put the downside pressure on the dollar for the last several months, because expectations have grown. If they continue to grow like that, the dollar may continue to come under pressure. Don't think it's over for the dollar bears just yet. We have to get past this week. This week is going to be very telling. Now, with that being said, you're going to have to be focused on the euro dollar. One of the things about the euro dollar is we continue, and you can see here from last week's drawings, we drew the top of that spike high as resistance, but we continue to claw even higher highs. There are a couple analysts that are looking at perhaps an ascending wedge setting up with the euro, something that looks like that. I could kind of get on board with that, I guess. But when you have an ascending wedge, that means you really have to breach the lower trend line in order for it to turn bearish. So in this case, we're probably going to have to see below 108, but more importantly, you're going to want to see below, this support would actually, it'll be right here. This support here, it comes in around 107.60. Then you start making lower lows. You're well below the trend line of the ascending wedge, if that's truly what's developing here. And if that's the case, then we know we've got a reversal. Between here and there, and what you see right at current price and basically just sub 108, 107.60, it is a very tricky area for the markets. I know a lot of people, myself included, have tried to short the euro unsuccessfully for myself. I tried to be short as it was in this wedge. This, and obviously being that I knew this week was coming up ahead of the Fed, the ECB, and the Bank of England, I knew that I didn't want to be too aggressive. So the old wartime saying, make sure you see the whites of their eyes, before taking a shot. In this case, if we get below 108, that might suggest that we have a reversal really setting up. 107.60. Those are the levels I'd be writing down if I was you taking notes right now. Let's also take a look at the sterling, because we do have the Bank of England. One of the things about the pound sterling is it has not been able to break out. Unlike the euro, where we've had the euro really just continue to forge new highs, the cable has not. So that is a risk if we see broad-based dollar strength following the FOMC. So, following the FOMC, if the dollar really starts to strengthen, because let's say the Fed, maybe is a little bit more aggressive on quantitative tightening, or the language is so hawkish that the market finally gets the message that, hey, the Fed's not going to really budge from here. If that's the case, a break back below this 120, it's about 122.90, 122.80. You can see the spike low here is 122.40. So really getting below these levels of support would be a big deal, and I think would suggest that maybe a longer term double top is setting up with the cable. But it's really difficult to say without understanding exactly what Andrew Bailey at the Bank of England is going to be doing this week. Now, there is I want to cover just a couple of more things in the currency market. I want to talk about the dollar yen. I also want to talk about gold, and I want to talk a little bit about silver, because obviously silver has been diverging away from gold. We've talked about it on different shows with Chris Weston. I was really picking on the silver market for not following gold. We're going to talk about that here in a few minutes, and we're also going to go into the bond market. But before I do that, I just want to say, if you have not had an opportunity to take advantage of the trader funding program, make sure you do so. I did, not last week, but the week before last, I actually filmed a video on how I passed the assessment in the trader funding program. We're going to get it out for you this week, but my colleague who's handling all of the editing, he has been out all week with strep throat, so we're going to get that video out to you soon. We also have another video from one of our traders that's been listening to us for years, who has passed multiple assessments. He's gotten paid a big chunk of money. He actually filmed a video on how he is going through, has gone through the assessment, and some of the tips and tricks that he's done in passing an assessment. So those videos are going to be coming out. So make sure you're watching them. But look, if you want to take advantage of being able to trade our money, and let's say you just don't have access to a lot of capital, or maybe even you have the capital but you just don't want to risk it, well, risk ours. So take an assessment. There's a one-time fee for the assessment. If you pass the assessment and you can make 10% return without losing more than 5% on a trailing basis and no more than 4% intraday, then you can access our capital. And then you don't have to take any of the risk, and you keep 75% of the profits. If you want to learn more about the trader funding program, all you have to do is click on this 2-minute video right here. You can find the link in the description of this video, so make sure you check it out. All right, let's get back to the markets, and let's talk about I want to take you over to the dollar yen, because the dollar yen has been locked in this descending channel. Now we're getting close to possibly breaking above this resistance zone. You can see we've had that resistance zone there for I don't know how many weeks. If you've been watching the week ahead videos, obviously this week on a more hawkish FOMC, more hawkish Fed, the risk would be that we see a break above this channel resistance. Now, I would expect that the upside is going to be fairly limited. The reason why is because this next month, as we go into February, we are expecting to find out who are the nominees for the Bank of Japan to take over Kuroda's position. All right, so as the governor of the Bank of Japan. So now, based on what we know right now, the thing is being a departure away from Kuroda is almost bullish yen. That means we're expecting more dollar yen or other yen pairs downside as a whole, just because it's not Kuroda. But really understanding who his replacements might be, who the nominees are going to be, that information and those names will be coming out later this month. But that means that we have a couple of weeks that we could get a recovery, maybe back towards this 200-day moving average right through here. I'm not saying that that's gonna happen. I'm just saying if we do have a hawkish FOMC, the play this next week might be looking for a move back above the 131.50 level, which would be right about here. Move above 131.50, and that might take us past the 50-day moving average back towards the 200-day moving average. Seeing a squeeze in the dollar yen back up towards those levels makes a lot of sense. What would be really great for people like myself and maybe you as well is looking for shorts up here around the 200-day moving average, or maybe the 50-day moving average, somewhere in this neighborhood, depending on how swift of a move we get in the dollar across the board. Like I said, I did want to talk about gold, because gold is and continues to be at resistance. Let me go ahead and remove this. This is from last week. You guys might remember that, but I'm going to go ahead and delete that right now. Here we go. Gold continues to challenge this channel resistance. 161% extension. We got a little bit above it, gave it back. Relative strength is divergent and overbought. You can see how we're making low. Whoops. Let me go ahead and grab this. I'll do this with the line. Let's move that down. You see how we are making a higher high in price, but relative strength did not. Relative strength made actually a lower high. So that's a divergence in relative strength, which does suggest that we would, will eventually get some downside, which is a high probability. It doesn't mean that it's going to happen, but it is a high probability. Now, what we'd be looking for in gold is really to show us a reversal would be a break below 1900. Now, gold's one thing, but looking at silver, that's another. Given the fact that silver has been struggling literally since the middle of December, struggling to make any inroad, any headway here, I'd be looking for a possible double top at these two levels. You can see that resistance right there, that resistance right there. If we have a double top in the silver market, once we break through this neckline right here, it becomes really quite bearish. Now, if gold sells off, I would actually be looking for silver to sell off at a more rapid rate, and I think it would be exponentially moving lower quicker than the gold market would be. That's just my 2 cents, and that's something that we'll be following pretty closely if it breaks through 2250 to the downside on spot silver. Last thing I did want to cover is I wanted to cover the bond market, because if you look at the 10-year, we did reject this 200-day moving average. You can also see, and I'm going to go a little bit more near term here, this is a neckline broken of a head and shoulder pattern, right? So if you let me grab the drawing tool here, okay, you'll notice that there's your shoulder, head, shoulder, right? Really, this blue line right through here is going to be the most important. You can see we're actually still holding above that. That is really where things are going to take a turn for the worse in the bond market, and you're going to see yields rally. I wouldn't expect anything like that to even remotely happen until after we get past the FOMC on Wednesday, but I think that is a possibility, and that's something that we should be looking for, especially if you're looking for a dollar bullish reversal. You would be looking for bonds to reverse, yields to rally. That would complement the dollar as it's rallying. I'd also be looking for a reversal in gold and silver, because if gold and silver are reversing to the downside, that the inverse correlation between the dollar and precious metals is very strong. So a divergence between those two would be expected. You would see gold selling off, silver selling off, the dollar also would be rallying, and that would suggest, then we're actually seeing, that this dollar reversal, or maybe even, worst case scenario, I say worst case, or maybe even scenario would be rallying past 103 and getting towards channel resistance, which would be up around 103.50. That's what I would be thinking there. So guys and gals, I just want to say, if you enjoy these videos, you think they're helping you, make sure you give me a thumbs up. Make sure you give my team a thumbs up. Subscribe to the channel so this way you don't miss any of the week ahead videos, any of the great interviews that Dale Pinkert does on F.A.C.E every single day. We put up those recordings right on this channel as well. So this way you don't miss any of these great interviews. Dale's interviewed like over 1,000 people over the course of the last several years. I think almost 7 years. So make sure you subscribe to the channel. And then also take advantage of this pricing discount, because it won't be here much longer. All right. And matter of fact, that should be canceled as of Monday. And then we're going to go back to our normal pricing. So guys, gals, my name is Blake Morrow. With Forex Analytics. Thank you for spending your very valuable time with me this weekend. I hope you gotten a lot out of this video, and good luck next week. I'll see you. No, oh, and I forgot to even mention, we have the jobs report on Friday. Shoot, where I'm just trying to get past Thursday, but Friday, then we got the jobs report. But don't worry, we're going to be covering that live on the F.A.C.E show on Friday of next week, which would be the 3rd. We'll be covering non-farm payroll live. Make sure you're there. All right, see you then. Have a great remainder of your weekend. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.